Just a few weeks ago, the AI trade looked completely finished. The semiconductor index had fallen more than 20% from its June record, officially entering bear market territory. And during one brutal day in June, roughly $1.3 trillion was erased from publicly traded chip companies. What if these companies are spending hundreds of billions of dollars building AI infrastructure that never produces enough profit to justify it? But apparently, Wall Street's existential crisis lasted about 3 weeks. AI stocks are suddenly climbing again. On August 4, the Nasdaq jumped 2.6%. Nvidia and Micron rose, and Palantir exploded almost 30% in a single day. So, what exactly changed? The technology did not suddenly become 30% better overnight. What changed was the evidence investors were receiving about whether businesses could actually make money from it. For most of the AI boom, investors were willing to buy almost anything connected to artificial intelligence. But eventually, prices became so high that being connected to AI was no longer enough. Companies had to produce nearly perfect results just to prevent their stocks from falling. Microsoft's own results illustrate the trade-off. Its cloud business has continued growing, but the company has also reported that investment in AI infrastructure increased costs and pressured its gross margin percentage. Add concerns about high valuations, cheaper competing AI models, and companies financing each other throughout the AI supply chain, and the market started questioning whether the entire trade had moved too far, too quickly. Those concerns contributed to repeated semiconductor sell-offs through June and July. Then, the earnings reports started arriving, and instead of showing that AI demand was collapsing, several major companies show the exact opposite. Palantir became the clearest example. Its quarterly revenue increased approximately 93% from the previous year, reaching around $1.94 billion. Investors responded by sending the stock up almost 30% in one trading session. Microsoft has also continued reporting strong demand across Azure and its AI services. Its cloud revenue reached $54.5 billion in its fiscal third quarter, growing 29% from the previous year. Nvidia has continued describing strong demand for the infrastructure required to train and operate newer AI models, while companies around the world are still building increasingly large AI data centers. The market had spent weeks preparing for evidence that the AI boom was slowing down. Instead, investors received evidence that businesses were still ordering infrastructure and that some AI companies were beginning to convert the spending into actual revenue. There's also a basic reason the rebound happened so quickly. Expectations had already fallen. After AI stocks dropped, investors no longer needed every company to deliver a flawless earnings report. A strong result suddenly became enough to surprise the market again. Investors who sold during the crash began buying back in. People waiting for cheaper prices entered. And everyone terrified of missing the next AI rally developed a sudden case of financial amnesia. The broader market environment helped as well. Falling oil prices reduced some inflation concerns, bond yields moved lower, and the entire American stock market rallied. The S&P 500 gained 1.9% on August 4. But one massive rally does not prove that every concern has disappeared. Big tech is still spending extraordinary amounts on AI infrastructure. Those investments are already pressuring costs and margins, and nobody knows exactly how long it will take for every data center to generate an acceptable return. AI stocks also remain extremely volatile. When companies are priced for enormous future growth, one weak forecast can erase billions of dollars before the CEO finishes the earnings call. And the recovery will probably not affect every AI company equally. Businesses producing rapidly growing revenue may continue recovering, while smaller companies surviving mainly on promises could still collapse. This means the AI crash may not have completely reversed. The market may simply be entering a more selective stage.